you struggling to nail down a strategy? Are you moving between different ideas and not finding any success with it? If you want longevity in trading, the best way to do it is to understand price action. No matter how the market moves, your edge is going to survive because your edge is you and your understanding of the charts. I've been trading pure price action for nearly 11 years now, no tools and no indicators. And if you go on my channel, you'll see videos of me using these concepts in real time. This isn't theory or textbook studies. This is over 10 years of experience of trading the same way and me dialing it down to the simplest form to teach you the most important parts. This is part 3 and the final part of my series on building a price action strategy. In the first part, I showed you a beginner trend continuation concept and the building blocks of how to trade price action. In part 2, I showed you a reversal concept, but also how to identify the key levels to trade around. Those 2 videos are the foundation to what I'm teaching in this final part. So let's get into it. If you enjoyed this video, if you learned something from it, hit the thumbs up, hit the subscribe button. It will really help my channel out. The first thing that I want to talk about is something called max pain level. You've probably heard the term max pain before, but I want to talk about it in terms of supply and demand. So here we have a downtrend and here we have an uptrend. And what I'm going to do is just mark a supply zone and a demand zone in here. For those that don't know, a supply zone is characterized by a drop, a base, and a drop. And a demand zone is characterized by a rally, a base, and then a rally. Max pain level is basically the extreme of the level. It's the end of that zone where when price gets back to it and you're in a trade, it's where you get a little bit of squeaky bum time. It's where you kind of start thinking and praying that it needs to bounce at this point. It's where the most pain is. The thing with supply and demand trading is that price is always going to gravitate towards the extreme of these levels. So for me, it's always made sense to focus on these areas only when looking at supply and demand zones. So if you follow any of my content, if you watch any of my videos, you'll see that I always mark my levels in this way. I always mark just the extreme. I've learned it's always best to focus on these parts, so that's all I mark. Also, it looks a lot cleaner on the chart as well. So this is what I mean. Price is always going to gravitate towards the extremes of these levels. In a supply and demand context, these parts of the zones are where you're going to get the biggest reaction. It's where the biggest orders usually are resting. The way I mark it for a supply zone is to use the top wick of that supply zone and then the highest close of resistance. And then for a demand zone, I would use the lowest close of support and the bottom wick. And that's how I define my zones. It's just the absolute limit of those levels. In part 1, I explained how to mark out ranges when they're forming. If you're an intraday trader, you want to be watching as these form. And I just mark out the range high and the range low, and I've got a specific way of marking that, and you can go back to part 1 to understand that a little bit more. So that's just a little bit of housekeeping out of the way. I just wanted to explain max pain level. I'm going to be using the range high and range low just as a little bit easier, but it's a way to show the levels a lot cleaner on your charts. So let's put it all together. We're going to be looking at trend continuations, we're going to be looking at reversals, we're going to be looking at trading them at the right places, but we're going to be utilizing different time frames to get the best risk reward. So you get to your charts and this is what you see. And this is on the M5 time frame. I'm going to keep this at the top just so you don't lose your bearings, but it's really important that we make sure we're definitely looking at the right time frame here. So I'll just turn the lights out so it doesn't get too invasive. Now we just need to map out things so we understand where we're trading. So let's mark the supply zone, and I'm just going to mark max pain level. It looks a little bit cleaner on your charts, right? And then down here we have a demand zone, aka a decision point, and this is what we talked about in part 2 of the series. This is where the buying took place to come up and take out that supply zone. So this is a key level. This is where we want to look to trade. Again, I'm just going to mark that down to max pain level because you can see it is a lot cleaner, and it's going to be where the buying took place ultimately from that low that took us to the high. So in the previous videos, this is how I taught it, all on the same time frame. This is all M5 time frame, where you'd look for the reversal pattern at that decision point, and then you'd look to go long, bag a 2.2R trade-ish, and this would have been your trigger to go long. That's your reversal pattern, all on the same time frame. Otherwise, there's also a trend continuation. Again, all on this time frame, you're not moving to a different time frame, and you can get maybe a 3R trade out of this, and there's your continuation pattern. That's what you learned in the beginner video. So again, this is on M5. Loads of people ask me how they can trade this on certain time frames. You can do it on any time frame. It will just look like this. However, what we're now going to look at is using an M5 level to find an M1 entry. But this could also be looking at H4 levels and finding an H1 entry, or maybe an H1 level and an M15 entry, or maybe a weekly level and a daily entry. It's completely up to you and your style of trading. For the purpose of this video, I'm going to be looking at M5 and M1 because that's what I do every single day. So we can see on M5 that price has engulfed the supply zone. It is now retraced back to that decision point and is testing the range high. I'm going to mark the range high and the range low like this. It's a lot cleaner just to show you the price action. So now we're going to jump on M1. So here we have M1, we have a lot more candles, and now we're going to look to find an entry basically around that M5 level on this time frame. You're going to either want to look for a trade at the range high, and we're going to look for a reversal at this point. And this is the reversal pattern which I've taught in the previous video. And you would take it like this on two high highs on the break of this range, and Bob's your uncle, and price moves away with like a million green candles. That's great. Sometimes you're going to find these reversal patterns at the range low as well, but also sometimes the range might fake out and then you'll get that pattern and the reversal there. These key levels, these supply and demand zones, if you go online, most people are going to tell you to trade them, but in reality, price kind of trades somewhere around them. It's going to build some sort of price action around those levels, not specifically at that level. When you're jumping down to the lower timeframes, you'll be able to see them build a lot cleaner. One thing that's important to note as well, however, is that if you're looking for trend continuations and you get a continuation pattern that forms at that range high, then you need to be wary of that. You don't really want to trade it at that point, because what you could see is that price ends up reversing. It bounces off that level and takes you out. So if you're going to look for a trend continuation, you want to wait for that range low to break first and then get your trade up like that. Another thing worth mentioning is in the reality of live trading, you're not going to have a completely textbook example like that where it just shows off this pattern really cleanly. It's going to look a little bit more like this. It's going to range a little bit more within that range, because remember, this is an M5 level. It's going to show an M5 pattern, and on the M1 charts, it's going to go sideways for a little bit longer. And when it does, you'll have to be patient. You'll have to wait for this range to build, and then you'll find the range that you want to trade. In this idea, it's a continuation pattern after bouncing off of the range low, and you would enter like this and get a million green candles again. Or it might be a continuation at the range low where price ranges, it tries to push up several times and then starts breaking the low, and then that's when you get your continuation to the downside. You just have to wait basically, but these are realistic examples. They're not just line drawings, or they're not just like hocus pocus stuff. The reality of trading is you're going to have to wait for ranges to build and then wait for the perfect time to enter. So like I said, on a higher time frame, things are going to build a little bit more, and you on the lower time frame are going to have to sit through a little bit more chop, but you're going to get that better risk reward. So this is what it looks like on M5. We've got M5 blinker at the top, look. So that's it basically. You want to find a higher time frame level, and then you want to drop down a couple of time frames in order to look for that pattern. Sometimes it's not as rigid as, hey, I'm going to look at an H1 level and then trade an M15. You may well find that pattern on M30. You might find it on M5. You've just got to look for those patterns around those levels and kind of go up and down between the time frames, just cycle between them. You're going to get a higher time frame move, but you're going to get a lower time frame entry. And this is kind of like the golden egg to how to get higher risk reward trades more consistently. It's having a higher time frame level, but cycling down to those lower time frames to get the entry and the right pattern. So now we're going to look at trading the failure of these patterns, because they don't always work perfectly. One of the things from the first video is that it was a super basic pattern, and yes, they do work in the right conditions, but real life trading is going to offer completely different scenarios, and this is what I want to talk about in this section. So we have this beginner trade pattern. It's a continuation pattern where we have step 1, the trend forms. Step 2, we define the range. Step 3, we wait. And then step 4, we have the breakout, if you remember from part 1. So here we have a big move up in price, and then your eagle eye notices that we have a range that is forming. So you mark it like this, and you wait for it to develop, and then eventually give you the trigger to enter. So you do what I taught, and you go long, and then next it starts to break down and takes you out. So let's look at why this didn't work. We have a big move up in price. So surely when you get a continuation pattern, the trend's just going to continue and just move up and up and up forever. It's 2025 at the time of recording this. These days, you don't usually see moves just rip and rip and rip and rip on any market. It's very, very rare. It's kind of like 1 out of 10 you see that these days. So you need to be a little bit more careful about where you're choosing to trade these patterns. Here, you're kind of looking at trading the continuation at the top. Believe me, I've taken many of these. It stings and it's embarrassing, even though no one's looking. In hindsight, you'll see that it's the wrong thing to do. If you're looking to trade a continuation, it makes more sense to do it after the initial impulse, not the massive continuation that happens after the first impulse. So we can see here that there are 3 failed pushes up, and then we have strong momentum to break the range low. You can trade this like that. It's given you enough of a signal that it wants to go back down because it's failed to push up. It needs to come back down now to reload. Or you could trade it like this, where you get the first lower low, and then you get a lower high, and then you get the second lower low, just as a bit more confirmation to trade it down. You might see things like this after you've taken a loss and then have to jump in and switch your bias immediately. But once you get enough experience, you'll get a kind of a feel for when these patterns are going to break down. This is just an example of how it does so. This is also an example of when the trend continuation fails, but I wouldn't particularly jump in short because the volume is quite low in this instance. It's not giving you that clean break that you get on the previous example, like this. So there's your trade. And now it's trended back down into this level here, which we marked out as a decision point earlier, right? So let's say you get to the charts and you see this. Price is now taking out that range low and you want a continuation to the downside. So price puts in the range and it starts to break down. And now you've got your typical trend continuation pattern, which I've told you about in the previous series. However, you've been stung a little bit from the previous trade. Do you just jump into this one? Do you trust it to just continue south? Maybe you just want to wait a little bit. Maybe you want to read the picture a little bit more. So we can see that price has a big uptrend and we have decision point, which we marked out earlier, don't forget, because it broke that M5 supply zone. Do you really want to be shorting this on a retest when you are going against the initial bias for the day? So you wait a little bit more and then you get your reversal pattern, and this is the way you want to trade it. And then you get rewarded with a trend continuation at a reversal point. And that pays for waiting for the continuation pattern to fail and then doing the inverse of that. One thing that I've been really hot on is that you need to master one pattern and all of its nuances. You need to just focus on that one pattern and everything around that. And it includes where to trade it, where not to trade it, and then where to trade the inverse of it when it fails. So let's look at the intermediate trade pattern again, the reversal pattern, where you get step 1 is the trend, step 2 you define the range, step 3 you wait, and then step 4 you wait for the breakout in the opposite direction to the trends, just to refamiliarize yourself with that. So here, let's say that price is at a decision point, a bullish decision point, and has put in this reversal pattern. Let's look at a little bit more context before we decide to do this. So this M5 supply zone is actually resistance on what is actually a big downtrend. So here, where we had that continuation pattern, price has failed to push up and it's put in a top pattern, right? It's put in a reversal there. So if we just bring it back here, do you really want to take a reversal pattern now, knowing that you're actually going against the higher time frame trend? You've just seen all those red candles. Do you really think it's going to reverse all of that? Here you can also see that there is low volume on the second push down on what would have been the continuation short, and then you've got the reversal to the upside. However, taking that into consideration that there is a big downtrend, you've got that reversal sign at a key level, but then you just don't really want to jump into it because you can't see it going back up to those highs, or maybe the risk reward isn't there for a particularly good trade. You just don't think it's going to reverse that trend. So you wait a little bit and then you get a big breakdown, a lot higher volume than that previous breakdown. So you can look to go short and then you can look to make a nice win. So in summary, what we've learned in this video is how to identify max pain levels within supply and demand zones. We've learned how to use higher time frame levels to mark out where we want to trade, where we want to do business, and then dialing down to lower time frames in order to find the patterns that we want to trade. This is for higher risk reward, or it could just be for confirmation that you definitely want to trade at that level at the right time. We've then looked at where these patterns fail, why you shouldn't take them at certain places, and how you can profit from the breakdown of them when they don't work out as expected. Like I said at the beginning of this video, I've been trading price action concepts for nearly 11 years now. I've not deviated away from price action. I think it's the most important thing in order to trade profitably for the long term. No matter what happens with the markets, no matter how much they change, you can take these skills into literally anything, whether you're trading gold, for example, whether you're trading crypto, or whether you're trading forex like me. All of these methods everything translates to every single market. That's the beauty about price action. And that's why I say your edge will never dissolve, because it will depend on how you are able to read the charts. And these things work on literally anything as long as there's enough volume in that chart. I hope you've learned something from this series. I've given you the building blocks and the foundation to building a price action strategy from scratch. And if you just take exactly what I've given you and you just focus on that for 1,000 reps, I guarantee you will find profitability in trading. It's that simple for me. There's so much fluff online, there's so much bullshit, and there's so many people who will read about these concepts and then rehash them in their own way to try and get clicks and to try and get money from views and for courses that they sell without really understanding how they actually move and how they actually work and how you can actually make money from them consistently. It all sounds very nice when you read things online, but when you actually go to the charts, it's a lot different. And I hope these videos have kind of given you a little bit more of a glimpse about what to expect when you take them to the live charts. In my opinion, all the way from the engulfing candles, all the way to max pain level and how to trade the failure of these patterns, these concepts are all you really need. These are all just the building blocks to understanding and giving yourself a map as to how to take this forward. So I truly do hope that you've learned something from this. If you have, let me know in the comments below. Give it a like, give it a subscribe if you're not subscribed to the channel. It'll really help me grow, it'll really help the channel. And I'd love to hear genuinely if you've enjoyed this and how you're looking to utilize it yourself, or if you've actually found success with it. Until then, I'll see you at the next video. The beginner video is here, and then the intermediate video is there, so that you can go back and relearn these concepts.